Welcome to Investor's Guide. You're watching ET Now. I'm Faye D'Souza. Now, this is a show that helps you find the perfect investment products in the market. And this week, we're looking at saving tax. It's mid-December, which means you only have 2 or 3 months to go. And the reason why we want you to start now is so you can split up that investment over the next 3 months and not have to put aside a lot of money from your salary in February. If you have questions about tax, write to us. Our email ID is at the bottom of your screen right now. Over the next half hour, we'll give you a list of the best tax-saving mutual funds or ELSS in the market so you can start making those investments right now. Everybody's talking about tax-free bonds. We'll find out how they work on the show this week. And finally, if you're a senior citizen, we'll tell you where you should invest to create a tax-free income. All right, so let's get straight to it. Now, we know that when you start making those investments to save tax, there are so many choices to choose from that it seems largely confusing. So before we get into telling you what you should and should not choose, here is a list of all of your options under Section 80C, 80D. And remember, if you have a running home loan, it takes care of all of your problems. So take a look at the options you have to save taxes this year.
We are sure you remember the time when you rushed to make those very last-minute investments last year. This year, to make the process painless, we have a list of tax-deductible investments you can work with. Let's begin with Section 80C. It allows you a maximum deduction of 1 lakh rupees, and the investments under this section are the Provident Fund, your life insurance premium, the equity-linked savings scheme, home loan principal repayment, stamp duty and registration charges, the National Savings Certificate, a 5-year bank fixed deposit, a 5-year post office time deposit, the Senior Citizen Savings Scheme, and the tuition fee paid for 2 of your children. Now, over and above your 1 lakh limit under Section 80C, you are also eligible for more tax benefits under Section 80D. The premium paid on your health insurance policy is tax deductible up to 15,000 rupees. If you are paying a premium for your parents who are seniors, there is an additional claim of 20,000 rupees. Under Section 80DD, you can claim a deduction up to 50,000 rupees spent on the care of a disabled family member. If the disability is severe, the eligibility can go up to 1 lakh rupees per annum. Section 80E qualifies you to claim the interest on an education loan for either you or your children for higher education. And finally, Section 80U allows you to claim a deduction up to 1 lakh rupees if you have been diagnosed with a severe medical disability.
All right, so I hope you wrote all of that down. Now, among all of the options you have to invest this year and save on tax, we're going to find out what the best options are. And to help me with that, I have Kumar, the CEO of Value Research, who joins us on the show this week. Dhirendra, thank you so much for joining us and welcome to our tax saving special on Investor's Guide.
Thank
you. Like
Like
I do every year, and we've reminded our viewers that they have to do this now and they can't wait even a day longer. Tell us why you believe that the ELSS is possibly the most efficient instrument among all of the options available under ETC.
If you look at, 5-year bank deposit, National Savings Certificate, PPF, they will all entail you a defined income. That apart, then you have the hybrids, which is primarily ULIPs, a small part going for insurance, rest of it going for, going as your investment, and they are generally hybrids, equity and debt combined. ELSS is the only option where it's fully invested in equity. It can have ups and downs, but if you are, this is and many a times it happens to be the only equity investment which individual investors make, and it has not really taken off. The primary advantage is that the only investment with upside. Think long term, invest regularly, think beyond 3 years. And even the gains on ELSS is tax-free.
I'm going to give you a quick recap. This is what we normally suggest you do on the show. You take your 1 lakh deduction, you minus your Provident Fund, which gets mandatorily deducted from your salary, then your insurance, your life insurance, term insurance payment, and the remaining you invest in an ELSS. Now, we've divided ELSS into 2 groups. There are aggressive tax savers and there are conservative tax savers. I'm going to give you the list of aggressive tax savers from Value Research in ET Now. This is the list: the ICICI Prudential Tax Plan, the IDFC Tax Advantage, and the Religare Tax Plan. Not in any specific order. You can pick any one of these 3 funds. Dhirendra, tell us why these 3 funds make your list. Let's start with the iPru Tax Plan. Why is it one of the best performers and why should we trust it?
No, broadly, classifying these funds on these two categories. When we classify the equity fund universe, we classify them into large cap. We classify, large and mid cap, or multi cap, or mid and small cap. So we have broadly classified them into two parts, and the aggressive ones happen to be, more tilted towards multi cap, or 40 to 60% into mid and small cap stocks. That is the primary driver behind this classification. And based on that, ICICI Prudential, because of its mid and small cap positions, also its ability to take some contrarian bets, which has worked very nicely for this fund. But this fund can be disappointing if you are looking only at 3 years. This might take a little more longer to fructify on occasion.
All right, so 3 funds on your screen right now. I'm going to go over that list one more time. There's the ICICI Prudential Tax Plan, the IDFC Tax Advantage, and Relega Tax Plan. These are aggressive equity ELSS, which Dhirendra said you can invest in. If you have a longer term horizon, makes sense to hold it past the 3-year lock-in. Let's look at the conservative tax savers. I'm going to go over that list now. The Quantum Tax Saving, L&T Tax Advantage, and the Reliance Tax Saver. Why have you picked these 3 funds, Dhirendra, and what sort of investor should be looking at a conservative tax saver?
Investors who have never invested in ELSS before, they want something which is not very high, which doesn't go up and down very substantially, and does not have much time. You are likely to take this money out in 4 to 5 years' time. They just might prove to be worthwhile. And these are large cap focused, broadly large cap focused tax savers. Why I like Quantum Tax Saver? It's value orientation and low cost. This is something which is quite distinct about this fund among all tax saving funds. Everything else being equal, this will give this fund, if there is a comparable fund which does just as well as Quantum Long Term, because of its low cost, will give 1.25% more return annually.
What about the L&T Tax Advantage and the Reliance Tax Saver, Dhirendra? Why do they make your list?
L&T Tax Saver for its superior performance and keeping away from substantially superior performance among the large cap funds compared to a large cap fund, and Reliance Tax Saver, despite its diversification scale, it has been a very solid performance delivered over the last 4 years, and this fund was struggling in its initial years, but last 3-4 years it has consistently done well. In fact, Reliance will benefit to replicate some of its other diversified equity fund to this fund.
So on your list right now are conservative tax savers that Dhirendra is recommending: the Quantum Tax Saving, the L&T Tax Advantage, and the Reliance Tax Saver. Now, if you have any questions about these funds or about tax saving in general, write to us. Our email ID is at the bottom of your screen. But don't wait too long, because you're running out of time this year. Start as quickly as possible. Let's move on. We have another question from Atul Kumar, who writes in, Dhirendra. He's picked 3 funds and he wants you to help him choose among them: the Franklin India Tax Shield, the Tata Tax Saving Fund, and the Canara Robeco Tax Saver. He wants to know which one makes most sense to invest this year. These funds were in favor about 2 years ago. They haven't been mentioned a lot since then. Have they slipped from favor? Has the performance fallen? What's your verdict on these funds?
They have slipped a little bit on performance, but I think that all the 3 funds are compelling choice even now. These funds remain good, and if one has to choose one of the 3, I would say that looking for a large cap fund, or if we classify it based on an aggressive investor, then he should consider one of the 2, the Tata or the Canara Robeco one. If one is looking for a stodgy large cap one, then it should be Franklin.
All right, so the Franklin Tax Saver Fund if you're looking for a conservative investment, Tata and Canara Robeco if you want a slightly nimble-footed one. We're going to take a very quick break. On the other side, Dhirendra will stay with us. We'll talk about generating monthly tax-free income for seniors, and we'll answer more questions about saving tax. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET now. Thank you for staying with us. Kumar is with us as well, and this is our tax saving special. Now we have another question that's come in our portfolio segment, and this one's come in from Nilima. In fact, her daughter has written on her behalf. Now Nilima is 71 years old, and she's invested about 13 lakh rupees in mutual funds so far. She has been receiving dividends from those mutual funds over the last 3 years. Now the rest of her money is in bank fixed deposits that contribute to her regular income. All of this together puts her in the highest tax bracket, and she wants to be able to create some tax-free income from both her mutual funds and her other investments. She wants to, she has very clear goals. She wants the tax saving. She also wants to protect this capital for some time so she can give it to her successors, and she wants to know if she can maybe get a little bit of growth from her investments as well. Now, if you look at the portfolio and the way it's designed, she's using fixed deposits for her income. She has about 10 mutual funds that she's picked for her equity allocation. Would you like to re-look at all of that? Perhaps should she be looking at our senior citizen savings scheme instead?
Yeah, I would strongly urge, one is that if she has a pension income plus, interest income from the fixed deposit, I think it will be useful to consider the tax saving bonds on offer right now. Many public sector banks, public sector companies and infrastructure companies are offering those. You can lock in your money for next 10 years or 15 years in such bonds and be assured of, such high returns. So first is to look at your pension income, if you have any. Else, you invest your money into the senior citizen savings scheme, which will be, which could be a maximum of 15 lakh rupees per person, and the income from that will be taxable. But if that's the only income, then you will not fall in a high tax bracket. Then supplement that with the tax-free bonds if need be, and the money from which you don't intend to derive income should be invested in for somebody who is 71 and want to protect the value of this capital, at the same time try and enhance it as much as possible without assuming significant risk. I would say that consider our stable growth portfolio, that, and maybe one or two funds from that to keep it even simpler, and maybe and not invest all that money at one go. Spread that money over the next 12 to 18 months.
But Dhirendra, the stable growth portfolio, then would you like her to continue to derive dividend from this portfolio, or should she, in order to make it tax-free, stay invested for a year and then all of the money there becomes tax-free anyways?
I would suggest that one should derive all one's predictable or income requirement from the fixed income investment. So don't get impressed by dividend from an equity fund. It amounts to the same thing. Derive your the need for income should be derived from fixed income, and this investment should only be for protecting the worth of your capital and making it grow to beat inflation.
All right, Nilima, I'm going to put that all on your screen in a really simple manner. First of all, instead of using fixed deposits, use tax-free bonds or the senior citizen savings scheme. So 15 lakh rupees in the senior citizen savings scheme, the rest of the money in tax-free bonds, and information on those bonds is coming up later on the show, so hang on with us. Now, if you want to, like you've told us, protect your money and give it some growth in the long term for your successors, and also you want the money to grow over time, then Dhirendra recommends our stable growth portfolio. Use the growth option here and not the dividend option, and of course after 1 year your money becomes entirely tax-free. Write back to us if you have any more questions about anything you heard on the show today. We have one more question. Dhirendra, Pradeep has written in. He tells us his father gave his daughter 50,000 rupees. He wants to put that money aside for the long term. Now he's confused if he should invest it in a non-convertible debenture where the money may be, may double, he says, in 5 or 6 years, or should he invest it in tax-free bonds with a lock-in of 5 to 10 years? Are there any other better options for his money to multiply? Now, since his only need is to have this money multiply, would you like him to look at equity instead of perhaps the tax-free bonds?
Absolutely. The tax-free bonds just don't make sense because his daughter won't be in the tax bracket if she may not have the income. So the tax efficiency or the tax-free nature of that income from that investment doesn't make sense. Then comes the non-convertible debentures. Of course you get a feeling that you are getting high return now, and they are certainly high compared to compared to what we used to get before. because interest rates are high. But that does not mean that your money is working hard enough, because you will not be able to beat inflation even with these high returns. And given that you have ample time on your side, invest in go for equity. But for somebody who has never experienced equity or has a notion that equity is too risky, but 10-year time frame, it is not as risky. If you are investing, you choose a good investment and remain invested for 10 years and don't watch the value every other day. If you are still conservative, then I would say that you approach it in a moderate way with a balanced fund.
All right, our stable growth portfolio is on your screen right now. And we keep talking about these tax-free bonds. Now, these are bonds where the interest you earn are tax-free. Here's a quick look at how these bonds work, and if you're in the highest tax bracket, whether or not you should use them.
For those of you savvy investors who have finally made the shift from keeping your savings in fixed deposits to tax-free bonds, there is plenty to choose from. A slew of tax-free bonds from state-run companies are expected to hit the market over the next few months. Currently, there are 2 issues of tax-free bonds available in the market. HUDCO worth 500 crore rupees and IIFCL worth 1000 crore rupees. Here are some of their features. The face value of both these bonds is 1000 rupees. The minimum investment is 5,000 and the maximum investment amount is up to 10 lakh rupees across 3 series. The interest rate HUDCO is offering ranges from 8.76% to 9.01%, depending on the tenure of the bonds, which are in the range of 10 to 20 years. IIFCL is offering an interest rate ranging from 8.66% to 8.91%, which is also dependent on the tenure of the bond in the range of 10 to 20 years. The interest will be paid out annually and there is no early redemption, but you will be allowed to trade these bonds on the exchanges. Now, if today you open a fixed deposit in SBI for a tenure of 5 to 10 years, you will get returns of 9 to 9.25% annually. So what is the case for investing in tax-free bonds?
Tax-free bonds are in a different orbit when it comes to returns, because if you are an investor in the highest tax bracket, you straight away have a 30% advantage. So for example, if you have you're getting 9% in a bank FD, after paying tax you are getting 6.5% odd, whereas here you are getting close to just under 9% tax free.
Another advantage is safety. Since these bonds are offered by companies backed by the Government of India, there is little or no risk involved. However, here are a few things to keep in mind.
If there is no liquidity, which means stock exchange trades don't happen, then you are stuck with it. Also a risk of losing to inflation. So if you get into a situation where inflation rate really shoots up and if it's in double digit, then these bonds are giving you returns lesser than that.
In spite of the concerns of low liquidity, the overall view remains that tax-free bonds are ideal for an investor who has a long-term investment horizon and financial goals like retirement plans and future education for their children.
All right, we hope you got that information on the tax-free bonds. That brings us to the end of this segment. Now, next week, we have a very special show lined up. This is our year-ender. We'll take a look at all of the portfolios we've been talking about. They've been running for 5 years, and we'll see how they're doing. If you've had an experience with one of our portfolios, write to us. Our email ID is at the bottom of your screen. Dhirendra, thank you so much for joining us on the show. We look forward to our special next week. Coming up after the break, we'll tell you how you can claim a tax benefit if you're paying the tuition fee of one of your siblings. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. I'm going to bring in Suresh Surana at this point. He's going to answer some of the questions you sent in on tax. Suresh, thank you for joining us.
Thank you.
Our first question comes in from Ashish. Now, he tells us he makes an annual income of 5.5 lakh rupees. He's a software engineer in Pune. And he tells us that his younger brother right now is doing his BTech and it's about 2 lakh rupees a year that costs them in tuition. And because his father is a serviceman and can't afford that money, Ashish has been paying that money. He wants to know if he can claim income tax benefits for this money. Should he show it going out of his own account? Should he show it going out of his father's account? What's the best way to do that?
The deduction which is available for the tuition fees is only for the children, which is basically for 2 children. You can claim deduction under section 80C. There is no deduction available for the tuition fee paid for the brother. So as such, you will not be able to claim any deduction. The only thing which is possible, in case your father has a taxable income, and in case the father pays the tuition fees, he can claim it as a deduction. You can separately gift to your father. There is no gift tax on the gift being given by a major son to the father. To that extent, probably some benefit can be claimed, but there is no way otherwise that by your paying directly the tuition fee, you would be able to claim it as a deduction under the Income Tax Act.
Our next question comes in from Vinayak. He's 76 years old. He tells us he has trouble filing his taxes online, Suresh. He wants to know if there's still a possibility in which he can submit the tax return in the physical form. What do you say?
Yeah, so Mr. Vinayak, there is a TRP scheme which the Central Board of Direct Taxes have come up with, and the details are given on www.trpscheme.com. There are a number of tax return practitioners who are there, including in your area in Thane, and they can help you to file the return electronically at a very nominal cost. Normally the fee ranges somewhere 250 rupees to 500 rupees. So it's a very nominal cost, and I'm sure you can find people in your vicinity who can help you in this process.
We have time for one last question. Swaraj has written in. Now, he tells us he buys and sells shares in the short term and uses the money, of course, and the profit he makes to buy more shares. Now, he doesn't tell us if he's a trader, so we don't know if that's a professional income. He wants to know how he should go about paying short-term capital gains tax. Suresh.
Swaraj, in the case of shares which are held for 12 months or less, any capital gain which arises will be termed as a short-term capital gain. And if you are selling the shares through stock exchange, you will be liable to pay tax at the rate of 15%. There is no exemption available even if you reinvest the same in buying some other shares for short-term capital gain. If you have been holding the shares for more than 12 months and then if you sell it through stock exchange, then the long-term capital gain is exempted from tax and there is no tax on that. In case you are holding the shares which are not listed, or the shares which are listed, but if you sell it, if you are selling it otherwise than through stock exchange, then the short-term capital gain is liable to tax at the normal rate of tax, which is, depending on the slab which you fall in, could be 10, 20 or 30%. But unfortunately, there is no exemption available for reinvestment of short-term capital gains.
All right, Suresh, thank you so much for answering questions on the show this week. That brings us to the end of the show. Remember, next week we'll start our year-end specials. We're going to take a look at all of the portfolios that we've been running on this show for the last 5 years. And the week after that, we'll give you mutual funds to invest in 2014. You don't want to miss either of those shows. Remember, you can reach me on Twitter. Thanks for watching.